Have you seen the chart for Wolfspeed recently? Ticker WOULF. It looks less like a stock chart and more like, I don't know, a seismograph during an earthquake. Just huge gaps, wild swings.
Yeah.
Pure drama. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. We're using our research with data pulled on September 26, 2025, and today, our mission is really to cut through all that noise around Wolfspeed and figure out what's going on with this bankruptcy restructuring.
Yeah, let's set the stage a bit. The broader market, it's kind of cautiously optimistic this morning. Futures are flattish, maybe slightly green. Q2 GDP got revised up, actually, to 3.8%. Pretty solid.
Right.
But Wolfspeed's troubles, they're happening despite that decent backdrop. So that tells you that the problems here are specific, deep-seated within the company itself. And then there's this sort of political fog hanging over things. Talk about maybe curbing chip imports.
Yeah.
As another layer of uncertainty for semiconductors generally.
Okay, so Wolfspeed itself, they're in semiconductors, specifically silicon carbide. That's the really important stuff for electric vehicles, right? High-performance EVs need it.
Exactly.
But the big, unavoidable headline is they filed for Chapter 11 back in June, bankruptcy protection. Now, Chapter 11, that's restructuring, not liquidation. They're trying to stay alive/debt. They did get a little bump, maybe 8% when the court approved their reorganization plan just recently.
Yeah, a very brief pop. Because, well, the fundamentals are just a mess. And you have to understand, that reorganization plan, it's usually brutal for existing shareholders.
How so?
Well, the goal is slashing debt, and the common way is a debt for equity swap. Bondholders get stock, existing stockholders get diluted, massively diluted, often. Which explains why analyst valuations are, frankly, all over the map. Some have intrinsic value at maybe $29, others down to a, frankly, nonsensical negative $64.
Negative 64, wow.
It just reflects the chaos. You've got negative earnings, negative free cash flow, revenue actually declining over 6% year over year. It's grim.
And Wall Street seems to agree. The consensus, pretty clear. About half the analysts covering it still rated a strong sell.
Yeah, the professional money is skeptical, to say the least.
Okay, so let's talk sentiment then. This is where it gets really interesting, I think. The bearish conviction.
Oh, it's staggering. Absolutely staggering. Look at the short interest.
Yeah.
We're talking 51% are SMET. 51% of the available shares are being sold short.
Half the float. That's enormous.
It's massive. More than half the shares available are betting the price goes lower, and the options market, it backs that up. The put-to-call ratio is 1.1. So 10% more bearish bets than bullish ones.
Is that level of short interest, 51%, is that itself becoming the story, like a risk factor on its own?
It's definitely both a symptom and a factor. The long-term chart, clear downtrend, no question, established weakness.
Right.
But yeah, that short interest, it creates this powder keg. Momentum recently flipped from bullish back to bearish, and it's picking up steam. Volatility was coiling, tightening up. You often see that before a big move.
And we're seeing that move now. Pre-market action today is, it's an explosion, all right? Pointing straight down.
Catastrophic is the word. Down over 20% as we speak. And it just shattered that $2 psychological level. Gone.
Okay, so what's the verdict then, looking at all this?
It has to remain a bearish outlook. That pre-market collapse is likely the market finally pricing in the massive dilution coming from that reorganization plan. It's catching up to reality.
Okay, bearish outlook. But we should acknowledge the risks to that view, right? There are always risks.
Of course.
One could be, maybe the reorg plan actually sparks some unexpected positive momentum. Unlikely, maybe, but possible.
Possible, yes.
And two, that 51% short interest. The classic risk of a violent face-ripping short squeeze if anything positive does happen.
Absolutely. That's the powder keg aspect. But right now, the immediate catalyst is this collapse. That $2 level, which was support.
Is now resistance.
Exactly. The new ceiling. So the door looks wide open for the bearish scenario to keep playing out. If the stock can't even get back above, say, $1.75 soon, that likely signals another major leg down. Maybe below $1.29.
And the only thing that really challenges this bearish thesis, the invalidating level for us.
It would take a major reversal. The stock would need to somehow climb all the way back up and close above $2 and do it on really high volume. That would suggest serious buyers stepping in despite the dilution.
Doesn't seem likely this morning.
No. Right now, Wolfspeed looks less like an investment, more like a high-stakes lottery ticket. And it's not looking like a winning one today.
So maybe the thought to leave you with is this. We all know EVs need these advanced chips like silicon carbide, but why is it still so incredibly hard and capital intensive to actually commercialize this stuff profitably? So hard that even major players end up in Chapter 11. Something to think about.
A very good question.
That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next deep dive.